So,
Yeah. There you go. Well, let's go live. Here you go.
yeah.
It's 9:30. It's a damp, dreary Thursday, but we're live and we're full of liveliness and colour. In full colour here with Paul Hill, is a full-time equity investor. And the markets, it's almost poor. I likened it recently to Vaccine Day. 2 years ago, that was pretty much Vaccine Day. Remember that? Was it?
Yeah, I do. Yeah. 3 years ago. Oh,
Pfizer?
yeah, that's right. Was it
Yeah.
2020, wasn't it? It was 3 years ago.
Oh, was it? Wow.
November. It was November the 9th,
Yeah.
2020, at
Yeah.
about, I think it was 1:30 when Pfizer and BioNTech announced those results. Not that it's etched into my memory when the markets took off by 10% immediately afterwards.
And it's crazy. And I liken that almost so when the Fed came out, not the Fed, the US inflation data came out below forecasts. And then we had our doing the same, our CPI coming in below forecasts. There seemed to be a huge surge in liquidity. It's almost like the change in tide. The tide comes in, one big sort of wave comes in, then a couple of others come in, and then of course it goes a little bit out, it comes back in. But I do feel now almost the tide has changed. And I've been saying this for a long time. I think we're going to see a Santa rally. I do think it'll roll over a little bit in Q1 because, of course, cost of living is not going to ease up on many people. Businesses are going to struggle for a while because they're going to keep those rates up higher for longer. They say that. I don't know if they will. But I do feel the tide has changed. Do you?
Well, I don't actually like to agree with you, particularly after last week when we were sort of dueling over charts. But in this case, I'm going to have to, yeah, because I'm with you. I think the narrative, investor narrative and sentiment has really changed because it was sort of like going into those inflation prints, sort of investors were thinking, oh, is the Fed going to hike again? And the probabilities were about a third. Now, if you look at the actual futures, the US yield curve, it's not pricing any increases whatsoever. In fact, it's saying there's going to be about 75 basis points, I think, next year. And even, I've heard a 100 basis point reduction in interest rates in the UK next year. So the sentiment and the narrative which drives prices is such that we've reached a peak in interest rates. Inflation has and is continuing to come down. And what the base case scenario for the economy is that we're going to have a soft landing. We are going to have a landing. Don't get me wrong. We are going to have a landing because the central banks will make sure that we remove any sort of last little pieces of inflation. But it isn't that hard, really nasty recession, which is a tail risk that people were worried about. And yeah, oh wow, this last week, I mean, my portfolio is just, like everybody else's, is up about 5% in total, which is like, I mean, Vaccine Day was up 10%, and this is 5%. So I'll take that any day of the week.
Yeah. Well, do you know what? I have never had so many. I mean, talking. In fact, look at that. First comment. By all means, comment. Any questions? A bit of housekeeping here. If you could like this, it'll get viewed by more people, and share it and subscribe to the channel. But also comment because Sharu, the vegan Westie, that's his name there. I found the last fundamentals versus charts debate between Justin and Paul very educational. Yeah, the arguing. Well, we can do a bit more of that because this is part of the thing. Indeed, I have listened to that video debate over and over again. Lots of gems in there. Well, I've got to say, over the last few weeks, I've never had so many alerts on the chart. I've been going back to the last 6 months. I mean, literally, because I do put alerts onto chart prices hitting the 50-day moving average. It's an early indicator. It's not significant of a trend change. Many stock prices can jump above that and come back down. The 200 days is more a long-term trend thing. But I've had so many, and in fact, many on your stocks.
Let's start with one of those. Did you get an alert yesterday on Verici Dx?
Oh yeah. Verici. I mean, let's have a look at Verici. Yeah.
It was top. It was top of the game gainers list yesterday by rising by about 100%.
Look at that. Hang on. Look at that. An alert on copper. That's a good sign. Copper, because copper, of course.
Oh yeah, Dr. Copper. Dr. Copper.
I mean, look at that there. You can see a bit of mess there, but you see 50 days, it's crossed that, and it's heading towards 200 days.
Well, you can understand that, and that's why it's called it Dr. Copper, simply because if interest rates are coming down, then there's going to be more usage in terms of infrastructure and build. So the demand for copper, and also, I don't know if you saw today, you had the UK basically saying that it was going to be able to, it was supporting its offshore wind. So anything that sort of like uses renewables in terms of sort of, electricity transmission, which is copper based, then it's going to help it. But I mean, Dr. Copper seems to work again.
Yeah, but you know, it's funny, wasn't it? The last auction for wind and all that stuff, and for offshore wind, there was no takers because the government brought the price down too, and so they're standing there in an auction, no one bidding or anything. And now they've upped it by 75%. The price at which they'll acquire sort of power there. So hopefully get a bit more thing. But this is Verici's chart.
Let's not digress into copper. Let's hit Verici, because that was bigger news yesterday. I mean, they announced, as probably people know already. I mean, I interviewed Sarah Barrington, the CEO, yesterday, and it went live this morning. So I strongly advise people to have a look at that, because there's masses more excellent information in that than or extra from the RNS. So really, really helpful. I mean, they basically said that they'd just signed a really transformational deal with Thermo Fisher Scientific to to take to market their Clarava early or prognostic test for kidney transplants. And if this is a first-in-class, also first of its kind blood draw test using immunodiagnostics, and for somebody of this scale and standing, I mean, let's be clear about it. Thermo Fisher are a $177 billion market cap company. If they were listed in the FTSE, they'd be just about bigger than AstraZeneca, which is the number one. So we're talking of an absolute huge life sciences company. And they have chosen, out of everybody, Verici, to basically go to market with their lead sort of like a kidney organ transplant test for predictive analysis. That just says everything, that the science is terrific. It's got a lead in its market. And these are really, really serious players. And just the essence of the deal is that Thermo Fisher is going to supply all of the sort of like, the supply chain, the billing, importantly, all the sales support. So they're going to they've got thousands of sales guys going into just about every angle and every doctor and physician and, sort of like transplant center in the US, and probably most of the places in Europe and the world as well. So these are huge. This is a giant company, and they're going to basically really sort of, jumpstart or really sort of drive that sales top line, and Verici are going to just apply the technology. So it's a terrific deal. They're going to get a sort of like licenses and fees of about $5 million, assuming everything goes to plan in the first 12 months, and then obviously royalties on the back. So it just says everything about the quality of the science. And as I say, it's a total breakthrough deal. Rubber stamping that this is a first in top class company, and it was only on it before yesterday. It was, market cap of only 10 million. It's only about 17 million now. And I know Singer's put a note out yesterday, and they upgraded their sales expectations. I think it was from roughly around about just less than 5 million for 2024 to $8.6 million for 2024. So a significant increase. And that's just just the start, really. And
well, it was I sort of moved 60%, I think, at the end of the day, close up. In fact, let's have a look. But I think on two fronts here, it was 74% up yesterday. But two fronts, I think this was, first of all, it's validation of the technology from a big player. And secondly, you've got that cash coming in, which I know is a loss-making sort of pre-commercialization company, pre-revenue companies, pretty much. Then it's relief on that side as well, isn't it? So validation, and then the balance sheet being shored up as well, which gave that a huge run, and it just shows how oversold it was. That in a day, I think at one point it went by over 100% in one day. Microcaps, nanocaps can do that, especially in bull markets. And I think just it was a good day to release news as well yesterday, because everything was sort of up, but that's good.
Yeah, well, it extends. You just say extends the cash runway until the end of next year. But frankly, they've got lots and lots of valuable assets in that sort of like, that treasure trove of R&D. And it's just as a matter of monetizing in the right way and choosing the right partners. And it gives the board optionality here. And I would not be surprised if they went full bore into a total sort of like, R&D, IPR licensing model, a bit like BioVentix, which is, I think it's about 170 million market cap company. And it trades on 13 times sales because it has huge huge margins. All it does is license out its monoclonal antibodies for medical diagnostics. And I could see these guys going a similar sort of route, for basically organ transplants. And also they've got this urine samples database.
That
as
was
well.
quite a unique deal sweetener, that, I thought. I read that. It didn't make me laugh. I mean, it's good. And so
you could make a lot of sort of like jokes there, couldn't you? Taking the pee.
Yeah, but listen, not exclusive. In addition, this is a license to access to just a portion of the company's urine samples.
Yeah,
that sweetened the deal.
but
urine samples.
Yeah, but that's just the tip. There's plenty of others, in that whole. She's talked about it. It's the fourth product they've got. I mean, it's all systems go. The math, the sort of the reality is commercializing as fast as possible, and these guys, are absolutely going to drive that top line. So fabulous deal, but really just the start. And as I say, Singers have got a target price of about 30p per share. But if you run the sort of like the 8.6, which is really just the beginning of that sales line, and you put a sort of like Bioventic style multiple of sort of 10 times sales on it, then you get a valuation of 40p per share. So you can easily see how this is going to accelerate, and just even to justify where the shares were, sort of like 2 years ago when they were at sort of 80, 90p. It wouldn't be out of this ordinary if they can really drive it, because they've done everything it's really unfair if you think about it. They've done everything operationally correct. They've hit their endpoints in their validation studies, and they've been pretty conservative in terms of their cash management and cash run rate. So they've hit every single milestone that they put forward for their IPO. But the share prices, like many others, have been slaughtered, and now they're perfectly placed with the likes of Thermo Fisher and others that they can bring in to really commercialize this. And I would say, if they can move into that type of, pure IPR licensing model with that new technology, and just concentrate on developing further the accuracy and the R&D and the treasure trove of all that sort of knowledge they have, then it's going to be another Bioventics on 10, 12 times sales. And why not sort of 200 million market cap in the same breath?
Yeah, but that's the opportunity in the markets, isn't it? As I said, it came to the market pretty much in started towards the end of the bull market, and it really shot up. Look at that. I don't know, but 30 pence to up 95 pence. And then all of a sudden, of course, loss-making pre-revenue stocks, when you get into this downturn in the bear markets, and the equity markets sort of freeze a little bit and says, worry about financing. You're thinking, okay, how long a cash runway do they have? Then that's where you get massive opportunity going forward. Because now it seems like then that's a large relief, from shareholders thinking, okay, they've got cash there to the end of 2024. Other commercialization deals will happen, and it sort of rallies. But like I said, the potential, massive. There's huge potential in these kind of stocks. Biotech, med tech, and all this stuff areas, huge. I mean, there's loads of them out there. It's just you just got to pick them at the right time, I suppose. A few comments. But go on. Sorry, Paul. Just first of all, Adam says morning both. Ben says hello, Paul and Justin. Phil says morning, chaps. Harris says hello all. Morning, folks. AI. Harris says, I recall my A-level economics. I recall that as well. That's when I first started learning about investing, actually.
When did you forget about it?
Hey. But and that's he actually started a stocks and shares competition, and I got addicted to it from then. Anyway, he says, I recall from my A-levels economics and impact of interest rates in the UK economy. Any changes in rates takes around 18 months to feed through into the economy. Yes, but my thoughts is this: you've got to understand the difference between the economy and the markets. The economy, like I said, will suffer for a while, but the markets are almost central bank driven, aren't they? I mean, when you see that the interest rates are not going to go any higher, and likely the next move is going to be down, the markets will try and price that in. And so as far ahead as they can try and price it in, they will try and price it in. So that's what the markets are doing. The markets are ahead of the economy. So that's why we're moving a little bit.
And if you want any evidence of that, look at the house builders, look at the banks, look at anything which is interest rate sensitive. It just moonshotted. It just took off, didn't it?
And exactly, but banks, especially, and in fact, I mean, I think Gleeson came out with an uptick saying they've stabilised mortgage rates coming down. But a couple of house builders. But it's not going to get easy for them in the next 3 to 6 months. But the fact is that people know further on down the line, it probably will get easier for them. So again, it'd be more buoyant, the house building market, and more mortgages applications will get better. So
Well, you might even find it's more quicker than that. And the reason why I say it is because mortgage rates are relatively competitive and they're priced off the swap market. The swap market's going to change once it gets knowledge, and you've seen that already, that interest rates are not going up in the UK. In fact, they're coming down. And so if mortgage rates are priced off as a falling swap rate for interest rates, then it means that the mortgage and house affordability is going to improve quicker than you might logically think for the house builders. So I mean, that it starts and it makes it much easier. And the reason why it's so important, certainly for me and you, is that in the small cap sector, the micro cap sector, it reduces that cost of capital, and that's been the biggest bugbear, because there's been a polarization in the credit funding market. You've had fairly narrow spreads on corporate credit over treasuries and over gilts. That's with the sort of like your listed securities, so your investment grade particularly. But for anything which is a private company, or for a small listed, which is not having a secure sort of like bond, which is or tradable bond, then this is the polarization at the other end. The cost of capital has just been extortionate for small and micro caps. And now with that sort of alleviation of the gilt yields, you might find we get that reversing. So more money comes into smaller micro caps, which means that fund managers then don't redeem, which means they've got more money then to fund businesses, reduces the cost of capital. And that is why it's so important. It's like if the market beta is 1, then for lower interest rates is like a triple, sort of like sort of booster for smaller micro caps, because the cost of capital comes down so much. I mean, I've seen 13-14% cost of capital convertible debt on many issues just recently, and that needs to come down, and that's why it's so important for what you and I do.
Yeah, I mean, because already UK lenders, there's now in a price war there. I mean, Nationwide has reduced theirs. I think HSBC adds, so they're all HSBC there. There's also Virgin, Halifax Money, and Nationwide. So they're now all starting to bring them down. So of course they're looking ahead pretty much. And like you said, thing, and even look at the share price of Gleeson. It bottomed out in January pretty much. It didn't go lower than that in January. So you can see how advanced this is. It's like, the outputs.
Do you still own these guys?
No, I don't. No, because it went up and it's sort of rolling over. And I thought, hang on a sec, maybe because we had that sort of bullish rally, didn't we, back in January? And I thought, this is maybe the bottom. I'm a year too early, pretty much. But you can see there, even there, it tried to rally a couple of times, just didn't sort of break previous highs there. But now, look at that. This is now breaking these two last previous highs, and it even got a series of higher lows there. So a lot of house builders doing that, and even I tell you, when people come out with less negative, a bit more positive results, and so but this the share price is ahead of that. So the markets are ahead of the economy, and that happens anyway.
There's plenty of other opportunities though, and one which hasn't moved yet, and I would highlight to investors, is Venture Life, and it hasn't come out with any news, but it's still been pretty much ignored. The shares are trading at around about 30p, slightly less than 30p. And this is basically a company that does essentially healthcare products, which are sold largely in chemists and also sort of like pharmacies in the supermarkets. And it came out with really strong first half results. Like for like sales were up 10%. So that's better than the likes of Halion. It's got improving gross margins. And the net debt is coming down from about, I think it's about 1.5 times EBITDA to the hoping to about 1.1, I think, by the year end. And so they're generating an amazing amount of cash. In fact, I think they're sort of like the brokers expecting sort of 15% cash flow yield. So you've got improving margins, you've got strong like-for-like sales, and largely that's been driven by increasing distribution and volume, which just says that effectively its sales partners, its distributors like Asda and people like that want to take more shelf space of these items, which just says everything that the product actually works. But the shares haven't moved, so I would say if you're sitting on a lot of cash, and the cost of capital is coming down, which it is with interest rates, these guys are going to do pretty well because they probably won't have that much debt this time next year. In fact, they'll probably have it down to about 0.5 or 0.6, given the amount of cash it generates. And, basically their sales are, going up by 10% like for like, and that should deliver a strong second half as well. So I would say there are still plenty of opportunities that have really been sort of like, forgotten still. And just to give you people on perspective on valuation, Haleon has got net debt to EBITDA of about 3 times compared to these guys, which should have about just over 1 times by year end. But Haleon trades at high, sort of like teens PE ratio. It's about 18, 19, I think. Whereas, these guys, Venture Life trade at about 8 or even less than 8, 7 or 8 PE. So, I mean, they're absolutely dirt cheap just because they've just been forgotten and liquidity's come out. So all I would say is that if you're looking, there is opportunity still out there. And this is in a healthcare name with strong repeat revenues. Because, I mean, if you've got sort of like, an ailment, etc., and you've got some sort of cream or thing you take for that particular, sort of like over-the-counter healthcare product, then you're going to stick with it because it's relatively cheap. It removes a problem that you have, which is long-standing. And, there's a lot of brand loyalty associated with these things because that's why they're liked. But it's got a cheap valuation. It's got a good balance sheet. It's generating an enormous amount of cash, and it hasn't moved even in the strong rally. So I would say, if you've got spare cash, then have a look at Venture Life because it's not a daft flipping stock, and it's priced to that.
Yeah, well, I mean, is it an issue here? Maybe this they were selling with it. It's Petrol Limited, probably less than 5% they've got now. So I mean, that was in was it 17th to 10th? So where are we in at the moment?
That gives a buying opportunity, though, doesn't it?
No, it does. Yeah. But the thing is, they can still keep offloading. This is why charts are so important, Paul. Because they can still keep off. You can look at that valuation and get better and better until that seller's done. You will know. You can keep a look at the RSs, or you can see there. A couple of support lines is broken down.
Yeah.
You need to get it back above that. And when the seller dries up, it'll pop above that, and it'll probably pop above it 2 a day. And then you realize, here we go. Here we go. Here's a
question. Here's a question. Why did you get out of Gleeson then with your charts, given it's another upward momentum?
No, it wasn't. There's a stop loss I put in there.
Oh,
Listen now, whenever I'll show you, I will send you my investment strategy. It's not just about, I say again, Harry said that, Sheree said fundamentals versus technicals. No. There's no fundamentals versus technicals. There's together. It's fundamentals plus technicals. Okay. And also there's portfolio management. That's part of portfolio management. What it did there, it went up, it broke their previous highs. But I wasn't convinced of that because look how steep that 200-day moving average is. It's still coming down in a downtrend pretty much.
It's higher lows, though. Higher lows, mate. Higher lows.
No, lower. No, look at that. Lower highs.
No. It's higher lows, not lower highs.
No, you need both. You need both because what higher highs are people are paying up for the price and they continue and they're not being distracted by sellers. So what's happening here? If you just this is a pictorial view of money flow. What's happening here? It's rising. Sellers are coming in. It's rising again. Sellers are winning here because every high is going lower and lower and lower. Okay, you've got some buyers at the bottom here, but what you need to do is break new. Now this has. Now Gleeson last 2 highs, look at that, it's broken it.
Yeah, okay.
So you can say if it can continue that to get above that high, that's very good because of course there's no selling, there's no net supply coming into the market. That's good. And like you see with Venture Life, there obviously is net supply coming into the market because whatever happened, regardless of the valuation, you've got to put that to good valuation. So first of all, it ticks the first box of fundamentals. Yes. Now technicals. Let's look at that. There's something going on there. It's not reflecting its valuation. Why? Because there's a seller in there. We can see it's a big seller. We've got 5% left, or just less than 5%. You can keep flooding the market with that. If you want to fight against
just
that,
let me give you a couple of scenarios, right? Okay. If that stock overhang goes, it's brilliant, isn't it? If that stock overhang shifts, this one's going to rocket ship higher, mate.
Yeah, but hang on, you talk about a trading. I'm not worried about that one big day move. I'm looking for, as an investor, you're looking over, 2-3 years. So
yeah.
you
And
know what
then
I mean? There'd be plenty of time to get in. It's like Verici now. So on my webinar,
hang on,
last night,
just before out, what's the name? We move on from venture life. I would say, yeah. I mean, obviously, I'm fully loaded in stocks. I mentioned it to you last time. I'm, the last couple of times, I've got about 2% cash. I can't be more loaded in assets at the moment. But if at the end of this month we do get a sort of like agreed bid for Equals, which is my largest position, then I will have certain funds. And if that's still if Ventures Life is still trading at 29p, I might well help that share price. We'll wait and see. Anyway, it looks too good to be true to me, to be perfectly honest. But I just say, the charts definitely don't yet confirm the solid fundamentals. I get your point totally, and I can understand the caution. You need if you're adopting a policy whereby it's fundamentals first and chart second, they've both got to align to give you that margin.
That's what I'm trying to say. Yeah, that's what I'm saying. I mean, by the way,
I understand that.
Here's an interesting. I had an alert yesterday on one of your stocks. Now, this is not a down. It's not it's not uptrend or downtrend. But look at this, PayPal, right? So I had that line there, whereas previous support there. And it actually broke that, right? Now, that's not a sign that the downtrend's ended, but it's a good start because it's literally, before it broke down there, you can see that big down day below that sort of support level. And now it's back at that level. So we may see a little turning here, Paul. Did it hit the 50-day moving average? It may have. There we are. Look on team 17 there. So that's quite a good start because it hasn't done that for, like I said, it's broken down to there. It hasn't done that for a while. Did it here?
I would agree. Yeah, I'm still down on my position, but not too much. I mean, I value this about $85 per share, so I've still got a long way to go up. But I mean, I'm as I said last time, the Wall Street hates this because for the same reason that I love it, which is obviously until either one of us is wrong, then this one's going to be a battleground stock. But anyway, let's wait and see. It's very, very cheap. I think it's set to do about $5 per share this year, about $5.50 for next year. So it's still trading at less than 11 times next year's, and it's got very good next earnings. It's got a very strong balance sheet as well. So. Yeah, I mean, it doesn't look so stupid, but there's lots of stupid stocks out there at the moment.
I'll tell you what you're going to like, Paul. This is a nice looking chart. It's starting to get this. You have one of yours, right?
GB Group. Yeah, I agree.
An alert on this, right? Yeah. And I mean, you see that it struggled. It has gone over the 50-day, which is the blue line, quite a few days. But now you see a nice bottom forming, and it's heading towards that 200-day. And it hasn't done that. It had I think it was a takeover, an offer back here in September 2022. I think it was.
That's correct. Yeah, about $5. Well, sorry, about £5. They didn't actually say it, but that was the sort of like the sort of speculated number.
Yeah, so if you just ignore that in terms of takeover event, as a one-off sort of event, and it hasn't really, crossed since 2021 November, and now it's getting really close to it, and it's come around because it's taken months to get there, which is quite nice. When you see that formation there, that means essentially bull and bears, sellers are pretty much exhausted, and you've got bulls coming in here, so that's looking quite good. I mean, look at that previous highs here; it's broken that, so that's looking quite good there. That could, you could be on a winner there, Paul. All right.
Well, I'd like to think so. Yeah. I would say with G, but I would like to say with G, it's not the cheapest stock I own. It's about 17 times. So, but that's on trough earnings. However, as we all know, M&A is just rife at the moment. You saw Hotel Chocolate getting taken out today by some Mars. That's it. Yeah. That the bar a day keeps the doctor away or something like that. I'm not sure what it was.
Look at that. Did you see that? That's where it is. That's where it closed at 137. That's where that is 365.
That's right. So and to be honest, it's another. I mean, Hotel Chocolat is a trophy asset, and also GB Group's a trophy asset. So I think there's probably a bit of speculation that somebody's putting a slider all over them. Whether it's or not, I don't know, but it's definitely something to look at. Another one which had come down in the sell-off totally unfairly, and it's a top quality stock, is Avingtrans. And I know we've talked about it, but they again just to rubber stamp the quality of their products, how leading edge they are. They've got about 30% of their revenues in the nuclear sector, and they signed a sort of like a deal with Bill Gates, his sort of startup company. Well, it isn't a startup now. He founded it in 2008, but they're building their first next generation nuclear power plant out in Wyoming called it's Terra Power. And it's based on, instead of based on coolant of water, it's based on sodium, and they want some specialist pumps to be able to help with that whole sort of like, you know, the coolant circulation processes. And they've been chosen out of the world to supply these pumps in it, sodium. I mean, this is state of the art stuff, and it's a demonstration project first, worth about $10 million. And if it goes together, they'll then build out the actual demonstration into a full-scale nuclear power plant that should come online in about 2030, I think it is. And if that works and it's all looking good, then they'll just license out the technology around the world. I mean, this could be a fabulous sort of like, you know, way to decarbonize the world. And the reason why it's even better than you think, not only because it's nuclear and therefore doesn't generate any carbon, which is obviously fabulous, but also, and not many people know this, the uranium it uses is spent fuel rods, which are basically buried. There's like hundreds of tons of this stuff in the Nevada desert in America. And so it will just take old spent uranium rods, which they would normally go buried underground for like the next 1,000 years. They'll use that to power these Terra power stations. I mean, what a fabulous way of recycling old nuclear material. So this could, if they've built the demonstration facility and got on the blueprint, then they're going to be built in. If this works, and let's be clear about it, would you bet against Bill Gates? I certainly wouldn't. Then if it works, then, you know, this is going to be a huge revenue stream for literally decades ahead. And the shares came off and they've come back up. And what it says to me is it's a high quality stock that basically the professional investors know that this is great. And if there's anybody loose selling, they'll just pick it up at any price. So I think there's a real strong floor to that. And let's be clear about it, with their medical sort of like products coming on, the small form MRI and X-rays, that could double over the next 5 years. And historically, that's what the share price has done. In fact, it's more than doubled every 5 years. It's doubled about every 4 years.
No, it's a stellar performer. I mean, look at that. Just scroll back.
Yeah, I know.
It's amazing.
That's where the technicals and the fundamentals align, isn't it?
Yeah.
It's pretty good.
Yeah.
Now, I've got a question for you, and because that came through on the as the questions last night on X. Destiny Pharma, what is happening there? It's just gone absolute like gangbuster.
Yeah, no, it's well, I think I'm about 120% on that. But
you sound annoyed there, Justin.
No, but
I'm only up 120%. What?
No, but you know what? It's nice. It's sort of validation, really, because at the time I bought, and I did literally, and it's a good example of me not really paying attention to when you're looking at pre-revenue stocks. Of course, how do you value them? In my mind, you know. So first of all, they've got to be cheap compared to the assets they have, the potential market size, even a conservative share, of a big market. It has to be a in fact, it almost should be a 10-bagger on a really tiny conservative share of a total addressable market. And I was looking at this, looking around at other, biotech stocks, biopharma stocks, and thinking, hang on a second, I don't understand this. So they're valued at 20 million market cap. They had about 10 million in cash at the time. They had 2 phase 3 ready assets, and then they did a partnership deal on one. So I just, they raised some money. I just jumped in, but it went down because the sellers came in. But then it rose back up. But if you go back, even look at the bull market here. This was before they had sort of 2 assets, and this was before they had a deal on one. I mean, it shot to 240. So even with today's rise, you can safely say it wasn't valued. It's not. They're more advanced now, even with a better board and better management than they were back then. And of course, that is the bull market. But yeah, it's still not. I don't think it's that expensive at all compared to where they could be. And if you look at other biopharma companies with one asset maybe in phase 3, they're still priced about the same size, and they've got a pipeline and everything. So it's, even though it's a little bit concerning how fast the rise has been, I think people are starting to realize it was undervalued. And you get that when you have something massively undervalued in a bear market, and people start realizing it, and then you get momentum. Obviously, it drives momentum. That's what happens, I suppose. But very happy with the result there. But
it should be. It's a nice Christmas present, isn't it?
Yeah, it's almost it's funny when you see people sort of taking profit, it goes back down here, and then it shoots back up. You think, when you get momentum in a stock like this, you should never top slice. You should never limit the downside. Maybe put a stop loss in, so if you own a profit, it'll take it out. But I mean, because you don't know how far it'll go up, you can keep zooming up and further and further. If you keep top slicing, like I read an article once, I don't know who it was.
Hang on, just on that. I mean, when will you top slice on that one, Justin?
I won't top slice.
I would have. I mean, I know you said I wouldn't. You wouldn't do it. But looking at that chart, if I was just basing on a chart, I would say, actually, I've just made 120% in short thrift. I'd probably take a quarter off or a third off.
Yeah, but the thing is, the difference is top slicing and we'll say shares, 100%. Risk reward, right? The risk on a share, it can go bust, 100% lost. Okay. Now I'm nowhere near that because, of course, I've done 120% up. So would you limit the downside? Yes. So I'm going to do that. I put a stop loss in at certain levels, but so I'll never not lose money on the stock. I'll never not lose anymore now because I'm in profit. I've got stop losses in, but I'm not going to limit the upside because that could double overnight again. The momentum is so strong. If you're going to buy coming in for this company, or even a good deal on their XF platform, it could shoot up. It could go like 2-3 quid. So why would I limit that upside? That's the whole point of shares. The upside is multiples. The downside is 100%. The upside is several 100%. So I'm not going to limit the upside. So what I will do is put stop losses in to make sure that now for me is a risk-free investment. Now, if someone said to you, Paul, I've got an investment for you, it's risk-free, you think they were stupid. But no, if you put a stop loss in, it is risk-free now. I mean, unless it gaps down below my stop loss, it was way below that anyway. But I'm not going to limit my upside on that because it's one of the stocks that can go absolutely bonkers because the markets they're in are multi-billion pound markets, and they're almost the next standard of care on the excess. So yeah, I mean, to me, there's still sub 100 million market cap. There's still way to go on that. So I'm not going to just limit limit my upside. Because like I say, if they come in with a big deal now, a big sort of company buys them out, like it can be a hotel chocolate tomorrow, so it doesn't matter. So that's what I'm saying is all you need is one of those in your portfolio. And it'll do you very well for the year, for the next 2 years, whatever.
Yeah,
so,
no, I would agree. Yeah, no, I was just interested.
So yeah, I have got stop losses in, but a bit lower than they are now. So I allow for volatility a bit.
Yeah.
But like I said, now it's a risk-free investment for me, and I'm taking that into consideration. You're going to miss those moonshots if you keep sort of top slicing, but you won't if you just put, if you limit the downside. That's all.
Yeah, well, you've certainly done well on it there, so you can't complain. That's for sure. You've got it right. Another one
is like good energy. That's I said for a while. What's going on with it? I didn't question what was going on. It's coming down here. I thought it's now literally. I mean, the net asset value of this was like 39 million or 40 million, and it was valued at 25 million market cap. They had like 17 million cash. So what is going on? I mean, they're improving the margins. They're going towards their energy services business, not rather than just supplying. So the margins are going to get better. The top line is going to dip a little bit, but the profit's going to grow. And I didn't understand. And all of a sudden, you obviously get some sellers there. It broke up the 200 moving average, previous highs here, and just shot up nicely. So that's another one I'm doing well at. And in fact, it's maybe symptomatic of the market just turning a little bit. You start to see shares starting to move a bit, and it's quite nice. So yeah, that's another one.
No, well done on both of those then. Yeah, no, there's another one actually with investors sort of highlighted that have a look at is IXICO, which is a really micro cap, something in your sweet spot of IXI, I think it's the ticker.
Yeah, I've looked at it. I mean, the problem with this is I'm looking at broker forecasts and growth going forward. There's lack of growth.
Put the chart up.
Yeah. There's lack of growth. I mean, I did like the valuation, but I said, before I've gone into stocks that have good value, but they haven't got the growth. And if you're looking at small caps, they've got to have growth. That's the most important metric of all. And if they haven't got growth, and if you can go look at the next 2 years, the broker forecast suggests that there isn't a huge amount of upside. That may change, of course, if they land some contracts. But what are they?
They're about 7 million market cap.
Yeah, I have looked at them. I have looked at them
4 million
quite a few
times. I mean, basically for investors, they're sort of an expert in neuroscience, and they help life sciences companies, particularly in sort of like Alzheimer's disease and Parkinson's disease and this sort of stuff, to bring their drugs through trial stratification to select the patients better. So, for instance, if things like Biogen or ICE are looking at sort of being able to remove the plaque on the brain, these guys will choose the right
Yeah.
patients for that trial and will identify where, to choose the patients who have got plaque, so they'll actually get the right sample data to improve, reduce the time, and to get the stratification correct on it. So they're definitely there. I would say, let's put the chart up again, because you look at it and they've come such a long way. This has all the hallmarks of, if the medicine now is sort of like, just ready to go, etc., it could really do well, but it is a very high return but probably low probability type of outcome, because you don't know what the Americans are doing in terms of this whole space, because they're real leaders in neuroscience, particularly in sort of like, diagnosing it and helping do the trials and this sort of stuff. And they're putting literally billions into this huge, big therapeutic area. So they might be the leaders in the UK, but are they the leaders worldwide? I don't know. But I would say, I thank the guy, the investor, for highlighting it, and it definitely looks interesting. But if I was going to buy it, I would put it into a portfolio of, sort of like high potential stocks with low probabilities that they're going to make a lot of money. And therefore, if you're happy to ride the volatility of that, or you have a low hit rate of about 20 or 25%, then you're probably going to do well. But I don't think it. I think that chart that you've put in there, really sort of like rubber stamps the risk associated with it going forward. But if they do have something there that's got a real USP against their global peers, then it could do exceptionally well, because there's billions and billions being pushed into, Parkinson's. And the reason why their growth has been negative of late is because Roche had a failed phase 3 trial in their Huntington disease, R&D, and on that basis, it knocked a huge chunk out of their pipeline and revenues over the last 18 months that they've been trying to recover. So I think they're just being basic. So I think those forecasts that you see through the broker are just really, sort of like lowball their base case, and they're something to reinforce the confidence in the business. But I think their cash burn is about 1.5 million a year. So the 4 million should last. But I'm with you. You don't go, if you've got spare cash and it's something that you're prepared to lose, then it might be something you'd want to go to. But personally, I try and have a higher hit rate rather than sort of have this portfolio approach of just sort of like quite speculative, massive return, but low probability bets.
Yeah, I mean, I looked at it and thought, do you know what? That's the perfect sort of size, and in this nice area, the sector it's in, the valuation looks good. Like you say, just off one time sales, pretty much, not far from
Less
that.
than, I think sales is 6.5 million.
Yeah, and they got cash 4 million. So literally, a lot of that is in cash. And I did like the valuation, but like they need, because it may spike if they done a contract that it may spike like crazy, but you can't predict that, and that's the thing. Like I said, they're not burning a lot. They're good value. They're in a nice area. Like I said, all they need is that one contract, and it can really shift. But I mean, I just looked at the broker forecast there, and they've got like just top line. They got 2023 6.5, 2024 6.5. 2025 7.2, and they're still loss making in 2025. So they're looking at adjusted EBIT, profit before tax of 1.4 million loss. So you're thinking, okay, I want to see on broker forecast on small cap companies, I want to see the end column, at least them going to profit and having enough cash to get there. But so that
I think they're kitchen sinked, Justin, to be too brutal.
I think they are. Yeah, I mean, let's say they come up with this contract that literally is barnstorming. I think it'll really rocket. It'll jump. But as yet, it's not the contracts.
The other risk, of course, being only a 7 million market cap, is delisting in this environment, because they're obviously having to pay 300-400 grand a year just on the listing costs. So it ain't cheap to be a public company. If they can't access money for their growth, then it's a chicken and an egg. They may even come out and go private. So it's always a risk when you go micro.
Yeah, absolutely.
Another one which came out with some really good news actually is Saietta, and I don't know if you saw that, which was basically they've got that signed that second contract with the Indian EV manufacturer for supply e-drives, really with their RFT technology, which is brilliant because it gives access, big access, and sort of like sort of a real sort of like case study into two-wheelers. So this is absolutely into motorbikes, which is obviously the main form of transport in India. And it's only a small sort of initial order, but over the next 3 months. But this is really the direction of travel is that it's going to go to about 12 million in the first 12 months for this order. And if you put it with the previous one, which was about 11 or 12 as well, you get to 24 million of annualized revenues. So this is really starting now to, and I forgot the pun, to motor. They're doing everything they said they're doing. As I say, what it comes down to me is when the demand is off the charts, which is the case, you've got to deliver. And they've seemed to set up a really resilient supply chain. They've got the products that customers actually want, which is great. They've actually got to execute that at the right quantity and the right quality as well over the next sort of 12 months. And then the last piece of the jigsaw is raising the funds to be able to finance the working capital to get those products to market. And I think at the Canaccord's last note, they did say it was about 9 million to 15 million pounds. I think they have to raise something of that order anyway. Yeah. So yeah, they're looking to do that at the moment. And I know they've got a cash runway until early next year, but that's only 2 or 3 months away. So I think behind the scenes they're working pretty hard on that one to get the relevant support. But when you've got two big contracts in the bag, and you've got sort of like visible revenues of 24 million, then that must help the funding discussions. And likewise with interest rates coming down, we talked about the cost of capital, and this one could, if they get the funding correct and those 12 months time, this could really spike up because it's got, as we said before, it's got industry leading technology. And it's a matter of getting it into sort of bikes and 3-wheelers and 4-wheelers in India and around the world.
Yeah, no, it's just that, like I said, that funding worry, isn't it? But people are standing back from this, waiting for the land out. And then once they get that landed, I think we'll see the share price move up, I think, nicely. But like I said, that overhang of that worry hangs over the stock a little bit, But there we are. In fact, someone's asked a question here. Sorry, I need to catch up on these comments. Let's go. So, hi guys, favorite UK dividend stock? That's from the TJ. Also, what's your choice for most undervalued small cap? Wow, some big questions there. And it also says,
okay, what's your dividend? What's your favorite dividend stock?
Well, generally, you flick that towards me now. But listen,
okay, well, I've got one.
My favorite dividend paying stock, it's not a stock, it's an ETF, which I own. It's a IUKD fund. And to me, I do find bigger companies a bit more boring. So I just cover off that. Just for FTSE 350, highest yielding dividend paying stocks, IUKD, it's BlackRock. It's an ETF. So that's what and in fact, even that of late, it's been in the doldrums a bit. But I mean, because it's been reflected FTSE 250 as well. But if I show the chart here, it's showing some early, so this is a support level, some early bounces here. If it gets above that 680, looking quite good because the 200-day moving average is there. But so I'm accumulating that. I think by about 1% of my total portfolio value on a monthly basis.
How much cash have you got left, actually, Justin?
28%.
Okay, right. So you've still got plenty of firepower. You might beat me into a venture life then, in that case. Okay,
do you know? I mean, I've upped my discipline on stocks, and literally because you can choose to be picky. I know we're sort of seeing the bottom of the market, but there's still plenty of time. I'm thinking, like I said, similar to you, I want to up my hit rate, and rather than more of a scattergun approach, I want to make sure the next stock I pick is a very high probability I get a very good return rate. So I think there's lots of opportunities out there, but you've got to look at everything, like I say, growth, valuation, health.
I'll give you two. I'll give you two dividend stocks. Okay, first one, big cap, which is enormous in the FTSE 100, 9% dividend yield, or it was when I last looked at the start of the week. It may not be now. Legal and General, L&G.
Okay. Oh, you had a fund manager chat about that, didn't you?
Yeah. That's just like, okay, it's bounced quite a lot because of the equity markets. But if we're now saying that interest rates have topped out and they're not going up, and in fact they'll be coming down, the stock market will do well. assets which it manages will do well, both bonds and equities, and their dividend, they just keep on paying it. So I mean, when I looked at the start of the week, their dividend yield was higher than their PE ratio. So they had 9% dividend yield and an 8 PE ratio. So it looks like a no-brainer to me. So that's the big one. If you want to go that way, obviously a huge insurer and asset manager, and then another one which I do own, is TP ICAP, and they came out with a trading update. Probably about 2 weeks ago, I think it was. And these guys basically are the go-to provider, interdealer broker, as people know, for OTC type products, for interest rate swaps and for forex and energy contracts and all the carbon and all that kind of stuff to help people to trade those. And when you get volatility, it really spikes up. But again, their PE ratio is about, even after it spiked up, it's probably about 8 or 9 times. They pay about 5% dividend yield. And I still think they're hugely undervalued. So I'm very happy to hold this one. And it's not as big as a 9% dividend yield, but I think this has actually got dividend growth written all over it, given the amount of cash it throws off. And they're actually going to be trying to release hidden value in their parameter solution for Legal and General. That's really rich at 9%, or you could probably 8% now after this sort of like this swoon up. And this one's at about 5%, I think. So there's plenty of income around. And then if you want, I mean, let's be clear about, Shell or BP probably pay 5 or 6%. The banks also, Lloyd's probably pay 4%.
Well, I got all those in my fund.
Oh, okay. Well, there you go.
Yeah.
Plenty.
Okay.
So what was the second question? It was, what was the most undervalued small cap?
Yeah, go. It's hard to say that, isn't it? But
you've got plenty, mate, and so have I.
Yeah. Well, do you know what? I'm not joking. I was looking at yesterday. One of my last investment was a Silver Bullet Data Systems. They came out with a bit of a news yesterday. They announced an independent platform for their 4D. Now, to explain to people, I mean, maybe people are not understanding this, but 2024 was a big year for digital advertising. Actually, the deprecation of third-party cookies. That means, when you get these adverts following you around the internet, that can no longer happen. Okay, because just the privacy data, GDPR, all that. So they've launched this AI-powered insights platform. It's an independent plan. They also sit on programmatic platforms where people buy ads via these massive systems that churn out billions and billions a day in things. But what's interesting, they've done 100 campaigns this year so far. And they've done 40 insights, and they've delivered these kind of metrics: 174%, 244, and 407 improvement on respective client measured KPIs. Now, what's interesting here, right, is they've got the programmatic director of Omnicom Media saying they've been using it with their clients, and it's fantastic, and they're going to use more of it in 2023 and 2024 and beyond. And they said it is a power of 4D, which is their product. They've been delivering outstanding results for the clients. Now, if you go and look at who Omnicom are, they're one of the biggest advertising media agencies in the world.
They're one of the top 3. You've got WPP, and then you've got another one, French one, and this one's third, I think.
Yeah. So that they're just validation of this thing is like huge to me. It's like, and in fact, before they did a trial against Google's suggested platform, and they beat Google's. And so this is rolled out very quickly. And they do say they're now very confident about continuing the growth they have. Now, this is if the forecast they hadn't forecast for over a year, but they come up with some new ones hopefully soon. But you're looking at like pretty much 10 million of revenue this year, up from 4.6. They're only 12 million market cap. They're going to be profitable next year. They've got gross margins like 80%, and that's going to drop through eventually. EBITDA margins of 30% plus. And I like this area. It's just, and I think people are missing something here with the stock. And it's like I had this with Destiny Pharma and Good Energy, and I'd be more specific about it. Thinking, what's missed here? I mean, they did say they may need to do funding. But they're going to be very close. So I looked at the cash burn, and they've been about £200,000 a month, and they had about £700,000. So they could get there, without needing it. But maybe that's that worry. But I just think this is one of these stocks that can scale massively, and this is what I'm looking for in microcaps. A tech stock like this with very good margins, very good scalability in a huge area, and being validated by massive companies. And if you look at some of the clients they're working with, like Omnicom, some of their companies, some of their clients are HSBC, Uber, and in fact, they
Oh yeah,
just
they're
won the new
huge.
national lottery. Yeah, they're the biggest clients in the world. So they're using that technology on their clients pretty much. I think that's validation right there. So yeah, so I do really like. It's early days. I want to see the growth continuing. But they
What's
do
your
say
position
here,
size on it? How much do you own of
I
this?
just about 10% portfolio value at the moment. I mean, chart
Sorry,
wise,
you just repeat that. You've
yeah,
got 10% of your
yeah,
portfolio in Silver Bullet.
yeah. Oh
Oh
yes.
right, yes, okay. This is a full on commitment then. This
I
one,
don't.
isn't it?
I genuinely see huge
Wow.
potential there, and I think it's going to be one of the standout performers on the UK stock market if they continue to do what they've been doing.
Yeah.
And I think if you do get some time, it's very illiquid. Be careful of that. They may need to raise some money, but I genuinely think they've got an excellent product here, and it's very scalable. And they're operating in a $700 billion a year market that's growing, digital advertising, and changing because of cookies. And I think, look at this, because they're not about convincing people to spend. These are about people who are going to spend, and they're showing them the best return on their investment for advertising using their AI contextual data models. So it's not about converting people to spending. It's about showing people if you advertise on these websites, you get 100% better traction or whatever. And they're doing that.
What's the market cap on it?
It literally is 12 million, I think. That's right.
Wow. Okay. So it
It's
definitely
very
could
liquid. You literally get volume 2,000 there. It'll drop by 5%. It's very volatile because it is 14 million actually. So, but it literally, 10,000 is the average daily volume, which is like 9 grand. It's nothing. Took me a while to acquire these, but it's one of those things. It's very, like I said, it's very liquid. But I believe, there's a pretty looking fella.
He's an ugly bug. Okay. All right.
Yeah,
Okay.
I
well,
like them a lot.
yeah. Okay.
And,
One which
I may be wrong. I may be
Yeah.
wrong. I've been wrong many times before, but I just think this. Look at the different things I like about it. It's like anyway.
I mean, what I own, which is less sort of like sort of like hyperscaler type of stuff, but that's what it's good to be doing. It's certainly perhaps less risky as well. And I've talked about it before because I've been adding to my position. Is AssetCo, and this is the last one I've regionally bought, which is basically a specialist equity fund manager, and it's headed up by a first-class management team. Martin Gilbert, who started Aberdeen Asset Management, and also there's a guy called Alex who's the CEO who's been with BlackRock for like 20 odd years, and so they've got a top class management team. And if you just do a sum of the parts, they've got 20 million of cash. The River and Mercantile business is worth at least 35 million, just on 1% of AUM. So that's 55. The market cap is 55. So that sort of like underpins where they are just through cash and through the River and Mercantile. And they've got other, sort of like asset managers as well, the smaller ones. And then the big sort of elephant in the cupboard, which nobody seems to really appreciate, is this Parmerian 30% stake they have, which it's easily worth 75, 90 million. I mean, Parmerian, just to give people an indication, will do 20 million of EBITDA. It's growing its top line. It's a digital sort of first. It's a bit like Fintel, yeah. It does basically information for IFAs, for financial advisors. And if you've got 20 million of EBITDA on a 10 times multiple, that would be that would just be a stupid giveaway price. It should be 15 times, which is about what Fintel is on, yeah. So let's just say 200 million. They own, basically 30% of that. So 30% of 200 million is more than the 60 million, is more than the market cap. So you could easily double from current levels, and that would be a really cautious valuation. So I could easily, I have a target price of 80p on this, and that's the smallest on the street, so to speak, because I think Singer's are about 97, and then there's, I can't remember, it's Zeus or somebody else is on about 120. And so when it comes to Undervalued, it's not a 12 million market cap, it's 55 million. But the asset backing on this, the management team, it doesn't need funding. It's got 20 million of spare cash, and it's just about reaching break even. It just seems like a no-brainer to me. Yes, I haven't got a big position because I didn't have much cash. I think I've got about 2%, just under or something, of my portfolio. But if you want something, they've got a decent time horizon, then this will re-rate at some point in time, particularly as the cost of capital goes down, because this is an asset manager, and as its portfolio in terms of equities, active equities in the Europe and the UK and India, those equities go up. They'll charge the same fee on a bigger base and make more money. And that's why the asset managers in a bull market do very well. They're a geared play, and they go down. So, hey, this one's not daft to own as well.
But no, do you know what? I'm looking at lots of asset managers. Like you say, they are very leveraged to the market, and when assets prices go up, they go up. I mean, if you can look at the back of that, look at that, the climb there is crazy.
Yeah,
But
I
that can
know.
happen. I do like, it does seem to be bottoming out. I mean, you see, like a 50-day moving average, early indicator,
Mm.
it is crossing that, trying to break it.
Mm.
It did that before, didn't last time break 200 a day. But like I said, if it, 200 days coming closer and closer, I think if it sort of breaks above previous highs here, 46.50 pence there, you could see the start of an uptrend. And like I said, we're literally weeks, months away from the market rallying again and liquidity coming back in, and these benefiting from that. So I am
Mm.
looking at asset managers. I want to have one of them in the portfolio, I think. But
Yeah. Well,
yeah.
as I say,
Mm.
if I get a big dollop of money from equals, which I'd love to have, but if I did, so like
Mm.
before Christmas, well, I'll probably get the money a couple of months later, so probably January or February. Then, Venture Life and AssetCo, I'll be at it. Well, I haven't got a position in Venture Life at all, but
Mm.
that'd be certainly one I'd be having a good, if it's assuming it's the same price. And AssetCo, I'd just add to my position. I'm sure I would, because it just seems
Yeah.
like a relatively low risk stock with double your money written all over it to me.
Yeah. And when even if equals doesn't get taken out, just ask all your family to give you cash for Christmas. That's what my kids do now. I just want cash. Yeah, I just want cash now. These are toys and stuff. Cash.
Bank of mum
Yeah,
and dad.
I know. Yeah,
Well,
yeah,
no. I mean, that's
yeah.
but I think again, you come back to that original question. You and I believe, and we could be wrong still. Let's be clear about it. We could be wrong, but we believe the narrative and the sentiment has changed and it's
Mm.
shifted from being, oh, our interest rate's going to go up. Oh, have we could have controlled inflation? You and I know it's perhaps a bit premature. We've declared victory on inflation. We think it's going down. Okay, continue. It has come down and it's going to stay down, and therefore eventually interest rates will follow suit, etc. That
Yeah.
case, that is basically like kerosene on a fire for small and micro caps. We're going to see these guys rip. Now you've had some of them like Destiny Pharma going up. We've talked about sort of like the big caps like PayPal. Yes, they've all gone up, which is great, but there's still a massive number of them who have not risen and not benefit. And AssetCo is one. And let's
Look
keep
at
it
the
going. Let's
yeah. But
keep
look
it
at
going.
do you see the Russell 2000 in America? It did
Yeah, I
that
did. Yeah.
jump. It did like literally 5% in one day, and even day after 5.44% in one day for an index. This is a
Mm.
small cap index in America, and it even went up. It didn't. You'd think it'd come back the day after that, but it just went up again the next day. So that's quite bullish. But
Yeah.
let's go through. Sorry, before we finish, but last few questions here. If quickly
Yeah.
cover them. That's it. What do you think about the shenanigans at Argentex? I know you got CFO, CEO gone, CFO gone. They just signed a non-exec this morning. I think that if I read they put a non-exec on the board here. So
Mm.
yeah, appointment of a non-exec director. What's your thoughts? Tim.
Massively over when the shares dropped to 60p, massively oversold. It's a good solid business. I've spoken to a number of sort of like people in the industry, and they've all said the same. It's a good solid business. It's got a decent management team, and there's nothing of major note in that business, and it'll recover. So I would say 75p is an absolute joke. It trades at about 8 or 9 times PE. It's got at least 15 million of distributable cash if it decided to do that. And we know from the rest of the industry, it's still doing pretty well. They've had basically a sentiment shift, so it was massively oversold. I'm actually, if people are seriously interested about wanting to put some money into it, I'm speaking to Richard Staveley of Rockwood Strategic, who's got a decent position in this. I'm speaking to that guy on Monday, and I want to probe him about this one, because I think this is hugely oversold for a quality business. And again, it's difficult to know, but let's just say, for instance, you put a 12 times multiple, which is frankly dirt cheap. Yeah. Then you'd probably be about 110, 120. It just did, it just smells of everything. It's massively oversold, and it's going to re-rate next year. And if you decide to put some capital in, you're going to do well.
Yeah. Okay. Well,
Is
yeah.
that clear enough?
Yeah.
Any
Yeah.
more?
Yeah. Interesting. Yeah. Yeah, it's odd. There's obviously some board stuff going on with the growth and then the CEO.
Yeah,
It's just
in
uncertainty.
In terms of the board stuff, okay. Yeah, the CEO obviously left and the CFO left. I think they were very close to one another. And what happened was that they didn't come. Basically, their second half hasn't met expectations. It was always a bit of a stretch, yeah. And they've had a bust up with a new chairman coming in, and therefore they've decided to leave both of them. So I just think it's a normal, course of business management change with a strong chairman who's decided, right, okay, we need more, sort of like, we need a slightly different, growth strategy, which we'll hear because I think they're putting strategic review at the moment. In fact, I tell you, I would not be surprised if somebody bought these and put a number on these, whilst they're down. But in the absence of that, because I think it would be a sort of like a relatively cheap takeover. In the absence of that, they're going to release their strategic review early next year as the management team. So I'll be looking forward to hearing about that. But yeah, I would not be a seller of this stock at all. Would not be a seller.
Yeah. Okay. Marv's used to own someone says used to own AssetCo. I think they offloaded Rise ETF far too cheap to Cathy Wood's ARC. In fact, it's worth looking at the interview Paul did. You talked about that, didn't you? About that. I think Rockwood had influence on the CEO and CFO going. Ooh, it's controversial.
Maybe. Well, find out Monday, I suppose.
Yeah. And Ben said, how do you avoid snatching small profits after such a long bear market? I know it's tempting, but like I said, in my opinion, what you should be doing is limiting your downside. If you want to do that, if you're in profit and like say 30% up, that becomes a risk-free investment if you put a stop loss in just above your buy price. And the upside can be massive. So don't limit the upside, limit the downside, but don't limit the
That's a great question, actually. Don't be tempted into small-term,
short-term profits. Because we're not used to, we just used the market going down and down and down. So anyone sees a quick, that's part of the market process, isn't it? When people stop seeing that happening, the market going down, people then don't go for quick profits. So you'll get less trading, you get more people holding on, and then the share price become, a bit more stable. They don't go up and down all the time, and you can rely on a sustainable rise rather than people just taking quick profits all the time. So yeah, it's part
however, as we come up to Christmas, if you want a sort of like a nice bottle of bubbly and a big box of chocks, then you could sell a few because you can really splash out then for you and your family. It's always quite nice to celebrate a few wins.
Yeah, exactly. Marvelous stuff. Don't forget, if you like the content, hit that like button and subscribe to the channel. And by all means, and we'll catch up in a couple of weeks' time. Cheers, Paul. Speak soon.
Thank you.